All right, hello everybody. Thank you for tuning in. Going to take a look at SPY and some of the things that are driving it. And we have a market that I would argue appears stronger than it actually is, and I will show you why. But I just want to say something, right? I was looking around at other trading courses this morning, on YouTube, on whatever, and it's like there is just so much garbage out there. Let me tell you something. As someone who was in the institutional trading world for 25 years, I can tell you this: there's no secret formula that always works. There's no one who gets 99% of their trades right. The real traders know this. In the markets, there are some price levels that are more important than others. That's just how it is. It's just the way markets are. Sometimes we know, sometimes we don't. Real traders pay attention to what the momentum is. That's how far something has moved in a given time. And real traders pay attention to psychology. All right, or I should say, good traders pay attention to psychology. The reason why so many people fail is because humans have not evolved in a way that is conducive to trading. When you're faced with a loss or you're faced with having a profit that you might lose, what does it do? It gets your emotions involved. It gets your emotions evoked. And when you're making emotional decisions, whether it's trading or in any other aspect of life, they tend not to be that good. So the difference between the really successful traders and the traders who aren't successful is the psychology. The good traders don't take big losses. Bad traders take big losses. All traders take losses. It's just the good traders don't take big ones. They get out while it's still a small loss. I mean, the great Steve Cohen himself, you can see in an article in the Wall Street Journal where he says his best traders only make money on 67% of their trades. Now, this is like the greatest trader who's ever lived. It's a little bit different. I think you could make money on a higher percent of your trades than that. You have to understand these traders are moving around hundreds of millions of dollars. So I assume you're probably not going to be doing that. But anyway, let me just get right into this. And we could see here, this is the S&P 500 SPY. And you don't need to be a former hedge fund trader or a market guru to see how this 416 level was important. It was resistance here, resistance here, resistance here. Now we may have broken out. It's going to take a couple of days to know. But what is resistance? Well, when the market's moving higher, there's not enough supply to fill all of the demand. So the supply is the sellers, the demand is the buyers. So the buyers are forced to pay premiums, and that forces an uptrend. When we get up to a resistance level, all of a sudden the tide turns. There's more than enough supply to fill all of the demand. The buyers can buy all they want to. And what happens is the investors who want to sell start thinking, gee, this isn't going higher anymore. That must mean that there's other sellers entering the market. So I better get more aggressive and be willing to sell at a lower price because the buyers are going to go to whoever is offering the shares at the lowest price, and I don't want to miss. A lot of times when you get to this resistance, you get these rapid sell-offs. We could see that here, we could see that here, and we could see that here. Now, a breakout is not just a symbolic thing. It tells us something. Every chart should be viewed through the prism of what does this tell us about supply and demand and what does this tell us about psychology. Well, if we're above this level that was resistance, it tells us that the investors who created the resistance with their sell orders have left the market. They either canceled or they finished. Regardless, they're out of the way. Now, when a market's moving lower, it's because there's not enough demand to fill all the supply, or there's not enough buyers to take in all the sellers have to offer. So the sellers are forced to offer their shares out at a discount, and we get down to support. The tide turns. All of a sudden, there is enough demand. There are enough buyers to take in all the supply, so the sellers can sell all they want without pushing the price any lower. Now we have the opposite that happens. Some of the buyers start to get to the sense like, oh, gee, there are other buyers around. That's why the price isn't going any lower. I better be willing to raise the price I want to pay so the sellers come to me. And we get a snowball effect, and we bounce off of it. So as traders, we look for important price levels because when markets get to them, they tend to move. Here we could see something else. This level that was resistance here mysteriously turned into support over here. This happens because of seller's remorse. There's a lot of people who sold here who thought they made a great decision when the price went lower, but when it goes higher, a lot of these investors say, you know what, I made a mistake, I'm going to buy my shares back, but I'm only going to do so if I can get them for the same price I sold them at. So you have remorseful sellers placing buy orders at the level that was resistance, and if there was enough, the level turns from resistance into support. So you can see right here, very obvious that there are some price levels that are more important than others. And if you know where they are, it's going to stack the odds in your favor. This is what's been driving the market higher. This is the technology sector. The S&P 500 consists of 11 sectors, and different things are in the driver's seat at different times. It's really important to pay attention to technology right now because it's pretty much the only sector that's doing well, to be quite frank. Now, we have resistance here, and we've got resistance over here at the same level almost a year later. How does that happen? Well, buyer's remorse. There are people who bought up here who regret doing so when the price goes lower. They tell themselves if they can get out at break even, they will. So you have remorseful buyers placing sell orders at the level that was a former peak. This is why markets tend to run into resistance at former peaks. We could see something interesting going on here too. Resistance here became support here. Resistance here became support here. Resistance here became support here. For some reason, XLK or the tech sector likes these price levels. I don't know why, but I don't need to know why. I just need to know where they are. Because if I'm thinking about buying something that's in a downtrend, I can look into the past and say, was this a former support level? Was this a former resistance level? If it's a level of importance, there's a good chance that if it reverses, it's going to reverse when it gets to that level. Now, this red line here is what we call a Bollinger Band. And this is important. It's 2 standard deviations above the 20-day moving average. Why is this important? Well, when statistics tell us that 95% of all trading should be within 2 standard deviations of the mean. So if we exceed that threshold on the upside or on the downside, that's going to draw traders into the market that are expecting a reversion back to the average. So in this case, it would be sellers. So we're above that, and the last time we were above this line was back here, and it was right before we had this rapid sell-off. Now, all the focus is on big tech, but there's other sectors in the market. Like I said, as a matter of fact, there's 10 other sectors. There's chaos going on in healthcare. There's stocks that are literally crashing, and I'm talking big ones. Take a look at the chart of Pfizer or United Health. We have what here is called a descending triangle pattern. Now, a lot of patterns I think are kind of bogus and don't really make sense to pay attention to, but this one's easy to understand. We got buyers who are hanging out down around here forming support around 130, 150, and they're just kind of chilling. They're okay with staying where they are. All right. So you can even say that they're complacent. At the same time, we have these lower highs forming. Markets go in peaks and valleys, and when the peak forms at a lower price level than the prior peak, we call that a lower high. This is what the descending triangle illustrates. Aggressive sellers, complacent buyers. When you have an aggressive seller and a complacent buyer, doesn't matter what market it is, whether it's the market for stocks or for apples, it's going to drive prices lower. Again, you look at a chart, you have to look at this through the context of what does it tell us about supply and demand. When you see that sellers are becoming more aggressive, I guess you could say there's more supply coming onto the market, and buyers are just kind of chill. This is telling us about psychology, right? There's no great secret. There's no great secret formula that always works. Also, too, in the institutional world, no one uses things like Gann theory or Elliott wave or Fibonacci retracements. I mean, if they do, in my 25 years there, I never saw anyone use them. But this is our communication services sector, and we can see that this is breaking out here. Now, like I said before, when you want to get insight into where the SPY is going to go, if you look at the different sectors, it could kind of help you get an idea. When you want to know where a sector is going to go, you can look at the stocks that are in it. Now, we can see here resistance remained resistance. Here, support becomes resistance. This is buyer's remorse. People bought here. When the price went lower, a lot of them regret doing so, so they tell themselves they're going to sell, but they don't want to lose any money, so they try to sell at break even. And if you have enough remorseful buyers placing sell orders, what was support can become resistance. Here we have resistance becomes support again, right? That's the seller's remorse. Now, this sector looks very strong. It looks like it might be breaking out. Well, here's the thing. Google is about 26% of this one sector, and Facebook is about 24%. So the two of these stocks make up half of the sector. And I don't know how many stocks are in the sector. It could be like 60 or 70. But they're weighted by price weight. By market capitalization. So the more market cap, the bigger the company is, the more influence it has on the sector. And sometimes this masks weakness. Now let me show you what I mean by that. In other words, if Google wasn't up so much, that XLC wouldn't be up either. It'd probably be trading sideways. Now let's go back to the end of the last bull market, which ended in December of 21, or maybe right in the beginning of January, but right at the end of the year / beginning of the year, this is where we peaked. This is the NASDAQ Qs, the NASDAQ 100 ETF. In this ETF, it's dominated by the bigger companies like Microsoft and Apple and Google, right? So what could be going on theoretically, or actually it was going on, is you have 100 stocks, but there's only maybe 5 or 6 of them taking it higher and taking the sector higher. And because they have such a great weighting, or such a larger amount of price weighting or weighting in the index, it could mask underlying weakness. For example, in theory, I mean, I don't know what the exact numbers are, but in theory, 85 stocks could be going down, 5 could be flat, and 10 could be going up, and it's going to make the benchmark look like it's going higher. All right. Well, the benchmark is going higher, but what it's doing is it's masking underlying weakness. Now let's take a look at this next slide here. This is the NASDAQ 100 ETF, where every stock has the same weighting. All right. Whatever the smallest stock is in the NASDAQ 100, which I'm not sure, but I know the biggest stock in the NASDAQ 100 is Apple. They have the same amount of influence on the ETF. Notice how this peaked in November, fully a month and maybe a month and a few weeks before the Qs peak. This was a sign that there was weakness, that the way the benchmarks or the way these indices are constructed was masking it or hiding it. People are starting to think, gee, this market's starting to look really weak, so I'm going to start to sell a bunch of my stocks that I think are risky, and I'm going to put my money into something I think is safe. Oh, what's safe? Oh, Apple's safe. Oh, Microsoft is safe. All right, so end of December, that dynamic where people are selling most of the stocks and only buying a few of the stocks kept the benchmark moving higher. But if we look at all the stocks with the same weighting, we could see the market really started to break down in November. All right, and this is something we watch at Stock Market Jobber. Now, we saw the S&P, right, is up, I think, about 10% year to date. This is the S&P 500, where everything is equal weight. It's not dominated by Apple and Microsoft. Apple and Microsoft are 13% of the S&P 500. So there's 5 stocks, and 2 of them are 13% of it. So they're going to have way more influence on the direction than a bunch of the smaller stocks. Here is the S&P 500, where every stock has the equal weight. All 500 are equal weighting. This doesn't look as bullish as the other things did, does it? This is telling us that there's only a few stocks that are going up. I think 7 stocks account for 80% of the NASDAQ move higher. And like I said, this could be a bearish sign because it's underlying, or it's masking the fact that the internals are kind of getting weaker. For a market to really be healthy, all the stocks got to kind of be going in the same direction. And right now, that's not the case. And again, we have this descending triangle pattern here. We have support down here, and we have, as time is going by, the sellers are getting more aggressive. They're willing to accept lower prices. So this is telling me that the market is not as strong as it appears, and I expect some kind of a pullback over the next few days or week or so. All right, thank you, everybody. I will talk to you soon.